Welcome back to FX Talk, an eBrief podcast all about the foreign exchange market. My name is Matthew Ryan. I'm joined by senior market analyst Roman Zaruk and market analyst Michal Jozwiak. Thank you both very much for joining. In this week's episode, we unpack the news that the US and the EU have agreed upon a long-awaited trade deal. Is this a good deal for America? How have markets reacted? And what are the economic implications for the EU? We'll also discuss another batch of quite remarkable economic figures out of the US. Could this delay the timing of Federal Reserve interest rate cuts? And we'll again scratch our heads and try and figure out what's going on with the pound, which has underperformed almost all of its major peers in the past couple of months. At first, we'll start with the latest news and developments since our last episode a fortnight ago. As we know, progress towards the striking of trade deals has been painfully slow since President Trump's 2nd of April Liberation Day. But we are finally beginning to see some signs of progress. First, with the news that the US and Japan had struck a trade deal following months of negotiation. And then the bigger news, which came over the weekend, that the EU and the US had reached a framework trade deal. This will mean 15% tariffs on most EU goods. There are a handful of special cases, notably steel and aluminium, which will be subject to 50% tariffs, while a smattering of others, aircrafts, semiconductors, a few others, will be subject to no tariffs at all. All the while, the ECB held rates steady last week, ending a run of 8 straight cuts, while Lagarde struck a slightly more hawkish stance, expressing confidence on inflation and hinting that the bank's easing cycle may be over. The dollar rebound against its peers has continued amid continued signs of progress towards trade deals and evidence that the US economy is performing very well despite the ongoing uncertainty. Meanwhile, poor old sterling continues to lag behind pretty much all of its peers. This follows a string of underwhelming data releases out of the UK, including the latest retail sales and business activity data, while public sector net borrowing also ballooned in June, once again raising fresh fears over the possibility of higher tax rates in the autumn. But what does this all mean for markets? We'll move on to our main segment of the podcast, the Market Pulse, where we pick out some of the main talking points in markets and give our thoughts on what these developments might mean for currencies, the economy, and wider financial markets. Let's start with the main news then, and that is that the US and the EU has reached a framework trade deal that will ensure 15% import duties applied to most, but not all, EU goods, while the EU has also committed to billions of dollars worth of spending on American energy and military over the next few years. The initial reaction in markets was one of relief. We did see a brief rally in European equities and the euro, but it seems as though the overriding feeling of disappointment has taken over. European currencies ended London trading on Monday as the worst performers globally. Roman, let's go to you. Is this a good deal for America? Has the EU dropped the ball during negotiations? What are your thoughts on this trade deal?
So the trade deal for Europe, I would say, is bittersweet. Because on the one hand, we have easing trade uncertainty, and this is one of the biggest pains for businesses, and this has been one of the biggest problems, because when you don't know what are going to be the conditions for trade, it's much more difficult to plan accordingly. And right now, businesses will more or less know the rules of the game, although those rules may change in the future, and we do not know all of the details. Still, I think that this easing in uncertainty is considerable and will help businesses to make plans. But at the same time, looking at this deal, they will be hit with 15% tariffs, which is going to make the imports from Europe less attractive. In this context, this is yet another problem after a strengthening of the euro that European manufacturers have to deal with this year. And looking at the 15%, this level is relatively high. It's a higher level than many Europeans have hoped for. This is also a level which is higher than what markets were expecting. Looking at market reaction, we saw a sell-off in European assets. We saw depreciations of many European currencies. In Central and Eastern Europe, we are still seeing that. I mean, broadly, not only in Central and Eastern Europe, but those have been the currencies that have been among the most hit. So the depreciation against the dollar was visible, and this is something that I think is not that palpable for people in Europe. There have been many criticisms of this deal, and this will have probably some negative economic implications. So there will be a hit to growth over the next few years, although the extent of this hit is probably likely to be relatively limited. So we are talking probably about something not over a half a percentage point of GDP. So on the plus side, there is easing uncertainty, but still there is going to be some pain related to this, and some deterioration in attractiveness of imports from the EU. Whether the EU dropped the ball and whether they could negotiate more forcefully, it's a big question right now, but we also do not know everything that is being discussed behind closed doors. There are other considerations for Europe than trade. For one, there is still war going on in Ukraine. There is still a security threat. It might be the case that Trump's turnaround on Russia, his more harsher approach to Putin, could be linked to this deal, that the European gave them a trade win, let's say, but at the same time he's going to be more protective of European interests security-wise, let's say. So overall, I think that this is not a terrible deal, and although it's not great, it will not sink the European economy, and we'll have to just live with it.
Well, yes, I mean, the deal has been very heavily criticised. There's authorities we've seen in France, Germany have come out saying this is not a very good deal at all for the EU. It's likely to lead to weaker growth in the near term. I think a lot of the bad feeling, ill feeling towards the deal is the fact that the EU had reportedly been long pushing for 10% tariffs. What they've got is 5 percentage points higher. And yes, you can argue, well, I mean, part of the struggle for businesses is that the uncertainty that the negotiations have created have been negative for businesses, for individuals, and this will provide a bit of clarity and an ability to plan ahead. So that's possibly an argument, but then you also ask, well, could the European Union have negotiated a better deal? I would say possibly. I think there's possibly they could have done, but the risk there is that they would have missed the 1st of August deadline. I think that would have been almost a certainty. And then what kind of damage would it cause in the near term? The EU would almost inevitably face higher tariffs in the next few weeks, few months. That provides more uncertainty, less clarity for businesses. So I think that's probably what's been taken into account is do we drag on this uncertainty for the next few months in order to maybe get a few percentage points off that tariff rate? Or do we just settle for a 15% tariff and remove that uncertainty for businesses? And I think they've just plumped for the latter. Whether that's the right course of action, we'll wait and see. Let's see what kind of impact this has on the European economy. As you said, Roman, I think it probably have certainly a non-negligible impact, but if it can be a relatively moderate one that's contained to, say, half a percentage point or less in the next 3 or 4 years, and actually, that's not too bad of a scenario for the EU. I wanted to ask as well about the ECB, because we saw the ECB holding rates steady last week. Lagarde struck a moderately more hawkish note than we had expected. But what does this deal mean for the ECB? Do you think it raises a risk of more cuts from the Governing Council, perhaps?
I don't think it dramatically changes the situation. This is still relatively in line with what they expected. So even though the markets have been quite disappointed with the details of this deal, this is not going to be something that is going to be forcing the ECB to act. I think that the bar for cuts is relatively high, at least in the near term, and this is not something that is going to change that, in my view at least.
No, fair enough, fair enough. Let's move on now. I want to talk about the US economy, which continues to expand at a solid rate. We're seeing remarkable resilience in the latest indicators of activity out of the US economy. Since our last episode, jobs data has continued to impress. The initial jobless claims dropped again last week. That's 6 straight weekly drops now in that figure. We look at the PMI numbers as well, business activity. They remain consistent with solid growth. The composite index increased to 54.6 in July. That's the fastest pace of activity we've seen since December, despite, of course, all the lingering uncertainty surrounding the tariffs. But what do we think this is going to have? What kind of impact this is going to have on the dollar and markets? Michał, let's turn to you. What do you make of this continued strong showing in the US economy? And it begs the question, should the US dollar maybe be trading higher than current levels off the back of this recent strength? What do you think?
Well, so starting off, incidentally, I think this period of very strong US data, both labor market and all the hard macroeconomic data, helped Donald Trump to negotiate the trade deals with the European Union in a more, let's say, pronounced aggressive manner, as there was much less of a risk of US going into recession than as to compare to example, the beginning of the year when the markets were very much worried about the matter. So I think starting off, this is one of the key matters as for the moment. And at the current moment, the greenback is, of course, backed by all of the optimism and all of the, feelings that investors have after the deal with the European Union. I think there's a lot of positivity from the US side. And I believe short term this could be continued. We see initial jobless claims dropping to levels not seen in over a month. We see very strong PMI numbers at over 54 with regards to the composite number. This week we also have the publication of the GDP number for the second quarter, which I would expect to be quite a bit higher than what we have seen in the first quarter, which was of course brought down by some kind of a front loading with regards to imports. So I would expect US economy to perform quite well in the short term, which could back the US dollar, and I would expect actually some kind of overperformance from the US currency short term. Although looking at the longer term, when we may start to see interest rate cuts and the divergence between the interest rate cuts between ECB and Fed might get a bit smaller, and also historically the Republican presidents actually tended to support a weaker dollar, which makes sense from exports, from the export side. I would actually expect the dollar to maintain its long-term or let's say short-term weakness and to remain levels close to what we see now or even a bit lower against the euro, which I think is still our baseline forecast and baseline assumption. Although, of course, in my opinion at least, inflation will have a great impact on that, and what we see with regards to price pressures, how the tariffs do impact prices, and how does the Fed react to all of that. Just before May, when there's a new Fed chair most likely, who, well, I would expect to be quite a bit more dovish with what we are seeing from Mr. Trump. I think we have a few candidates from the positions, and Bowman possibly is one of the most likely to overtake over Chair Powell.
Well, that's an interesting subplot, isn't it? As we know, FOMC Chair Powell, his term is due to end next year, May 2026, and there's been a lot of speculation as to who's going to take over once Powell goes and whether or not Trump will be forcing Powell out or try to force Powell out before that time. I think we could we're recording this on a Tuesday. The Fed meeting is on the Wednesday, so many of you might be watching or listening to this after the Fed meeting. But it's going to be an interesting one on Wednesday, because I think we're now looking at a scenario whereby a couple of these FOMC governors, you mentioned Bowman, there's one other, I think it's Waller.
Waller, I think.
Yeah.
I think it's Waller. Who the two of them may well vote for a cut at this meeting. Those are two picks incidentally from President Trump during his first term. So we are seeing this a little bit more greater influence from Trump, perhaps you would say, on US rates and on Fed policy. That's not necessarily a great sign for the dollar. Whenever we sort of see some sort of interference from the government into central bank policy, it tends to end quite badly for the domestic currency. Let's see if that continues to play out in the next few meetings and few months. That's going to be really interesting. I want to finish our main topics by talking about sterling. We talked in the last episode about the recent underperformance in the pound, as markets reacted to a handful of soft economic data releases out of Britain, most notably the disappointing monthly GDP figures. Well, not much has changed since then. News last week was not particularly great. UK government borrowing ballooned more than expected in June to almost £21 billion. That's versus 14 billion from a month previous. The latest business activity PMIs have been soft, now just only above the level of 50 that separates expansion from contraction. Retail sales, which is a proxy for consumer spending, did rebound in June, but it was below forecasts and was nowhere near enough to recoup the downturn from May. This has raised fears over the possibility of stagflation in the UK. And the pound has reacted by not only losing ground against the dollar, but it's also sold off against practically every other major currency and is now trading at its lowest levels since late 2023 against the euro. I guess the big question is, where do we go from here in sterling? I think, as we mentioned before, we've had a pretty upbeat view on the pound in the last few months or so, but I think that view and our conviction in that call has very much eased in the last few weeks. On the one hand, you've got an economy that is barely growing, whereas inflation is continuing to edge up. It's almost double the Bank of England's target. The Bank of England is stuck in a quandary whereby it's thinking, do we cut rates at an aggressive pace in order to support the economy and hope that this inflation spike is temporary, or do they hold off and focus on inflation, which of course is their sole mandate? All the while, we've got this nagging risk that a Labour government will be forced to either borrow more in the autumn or, more likely, raise taxes. We already know that they've tried to cut welfare spending, and that proved unsuccessful. So all of this creates a mixture of uncertainty for the pound, and I think our view has certainly softened. We'll be looking at our pound forecasts in the next few weeks, and I think there's a very good chance we could downgrade our view for sterling over the next sort of 6 to 12 months as a result of those uncertainties. Do you guys have any thoughts? What do you think about the pound? Any view of where we go from here?
So any news from the UK that I saw in recent weeks and months has been negative. Practically all of the headlines, and it's either something erratic politically or economic data-wise. I don't recall anything that would really be providing a silver lining right now. I'm particularly concerned with the public finances of the UK and also the political landscape. And this is something that is probably going to linger on for longer. And if you are going to raise taxes, then it's also something that it's not going to be positive for growth. So whether the UK economy will be able to make a positive turn in the near term, I don't think it's particularly likely. So for me, I think that probably it's not particularly good moment to be a long pound.
Well, although we have seen quite a lot of rather hawkish signals from the Bank of England, so well that could serve as one of the arguments towards maybe some strength of the British pound. That said, I would expect that at least until those fiscal problems will remain in the headlines, that the pound will remain under pressure.
Yes, I mean, it's a complicated outlook at the moment. As you said, there is all that uncertainty surrounding the fiscal side of things. But as you mentioned, Mal, I mean, the Bank of England looks likely to cut rates only quite gradually, particularly with inflation at the levels it is. UK is not exposed to the trade war. Actually, we got a very, well, I wouldn't say a very good deal with the US. It wasn't a particularly good deal on paper, but it's better than what we've seen with Japan, with the European Union. They're seeing higher tariffs than we are in the UK. So there is some reasons to be positive. But as I said, I think our view, which was very optimistic maybe 4 or 5 months ago, probably will need to soften that stance in the next few weeks, I would suggest.
Yeah, actually, the US-EU trade deal is something that is going to make British exports relatively more attractive. So perhaps there is a silver lining in all of that.
Yeah, absolutely. Let's move on now. We're going to finish with buy, sell, or hold, where we each pick a currency, or we pick a currency, and we each give our thoughts on whether we buy, sell, and hold that currency. This week, we're going to talk about the Swiss franc, and that's an interesting currency that has performed remarkably well since the start of the year. It's been the second best performer in the G10, behind only the Swedish krona, and it's been by far the best performer in the last couple of months, amid safe haven flows into the franc, in part due to the uncertainty surrounding ongoing trade. The SNB has also been quite reluctant to cut rates into negative territory, which again has provided a little bit of support for the franc of late. But what's next for the currency? Is it a buy, sell, or hold opportunity? What do you both think? And a short rationale to back up your answer.
So for me, it would be a hold. So we had what I would consider a regime shift with regards to behavior of the US dollar. Dollar is no longer king, and the Swiss franc looks to be one of the best, if not the best, alternative to the dollar, at least in the world of foreign exchange. Looking at the economic environment in Switzerland, it looks pretty good. And while we may get some easing from the Swiss National Bank, I don't think that there is particularly large room for further rate cuts. At the same time, the Swiss National Bank may not be too eager to weaken the franc, considering that they could be labeled a currency manipulator by the US. So I think that there are reasons to expect the franc to remain strong. There is also all of the geopolitical uncertainty in which the franc normally thrives in. But at the same time, as you mentioned, the currency appreciated quite considerably since the beginning of the year. It's one of the best performers. So that's why I'm only going to be saying hold rather than buy.
So the franc has been one of the best performers worldwide this year, and that is due to, I think, two key factors. First things first, it is a European currency, and most of them actually performed really well this year. Second, it's a safe haven currency. And while the former, well, it's questionable how will being a European currency impact the strength of it. The safe haven sort of boost that the Swiss franc received in recent weeks and recent months might be a bit weaker going forward, at least with all of these deals that we are seeing, all of these agreements. Possibly there's less uncertainty on the markets. Although in a Trump world, we should never cross out this possibility that we once again go into a full risk-off mode, and safe haven currencies such as the Swiss franc, such as the Japanese yen, actually get supported very heavily. But my base case scenario would actually be a Swiss franc sell, which is maybe in some kind of an opposition to Roman.
So one hold, one sell. I'm going to tip the balance in favour of Michał. I'm going to go sell as well. I think the main reason for that view is the appreciation that we have seen in the first, say, 6-7 months of the year. We've seen an extraordinary rally in the franc that's left it trading at very strong levels. That would perhaps leave it prone to a bit of a retracement. I also think the trade uncertainty is easing. We're seeing that with the signing of some deals, particularly with the EU and Japan. That should lower this risk premium, and it should increase risk appetite. Generally, that means that's bearish for the safe havens, including the franc. And I think we look at inflation in Switzerland is pretty low, and generally, if we want for central bankers to lift inflation back to target, that they would have a preference for a weaker currency. So I think there is that possibility. The SNB orchestrates a slight depreciation in the currency. So I'm going for a sell as well on the Swiss franc. And I think that's everything from us today. We're going to wrap things up there. So thank you all very much for listening or for watching. And we'll catch you on the next one in a couple of weeks' time.